Why 1-ounce gold bars are a smart investment this August. Imagine a world where economic uncertainties loom large, geopolitical tensions simmer, and the future seems unpredictable. In such a landscape, gold has always been a beacon of stability and safety. This August, many investors are rediscovering the allure of this precious metal, and one particular form, 1-ounce gold bars, might be especially smart to consider. But here's where it gets interesting. Not all gold investments are created equal. While ETFs and mining stocks offer indirect exposure, physical gold, particularly in the form of 1-ounce bars, stands out for its tangible benefits. So why might 1-ounce gold bars be a wise choice for your investment portfolio this August? Let's dive into the reasons. Firstly, the short-term gold price forecast has seen a significant boost. Recently, Citi analysts revised their short-term gold price target to $3,500 per ounce, a notable jump from the current price hovering around $3,300. They attribute this upward adjustment to a negative U.S. outlook, characterized by weak job market indicators, slowing economic growth, and an increased demand for safe haven assets. If this forecast materializes, investors who purchase 1-ounce gold bars now could benefit from substantial price appreciation in the coming months. The advantage of 1-ounce bars is their ease of sale, making it simpler to capitalize on price rallies without needing a large initial investment. But what if gold doesn't reach the $3,500 mark? Even then, the overall upward trend and institutional optimism suggest there's potential for growth or at least a reliable store of value in the near future. Secondly, inflation is on the rise again after a period of decline. Recent CPI data indicates modest increases in housing and food costs, raising concerns about whether the Federal Reserve's efforts to combat inflation are truly over. Inflation erodes more of cash and low-yield investments, but gold has historically provided a hedge against it. As fiat currencies lose value, additionally, these bars often come with lower premiums compared to fractional gold coins, making them a cost-effective way to enter the gold market. In conclusion, there are compelling reasons to consider 1-ounce gold bars as a potential investment this August. From favorable price forecasts to inflation concerns and the flexibility they offer, these bars combine the security of physical gold with the advantages of smaller denominations. With expert predictions pointing towards a possible surge in value, now might be the right time to act. However, it's crucial to evaluate your broader investment portfolio and financial goals before making any investment decisions. If your objective is to safeguard against inflation, diversify your holdings, or capitalize on potential short-term gains, 1-ounce gold bars could be a valuable addition to your investment strategy. What do you think? Is this a smart move for your financial future? Gold's winning streak, economic slowdown, and market insights. Gold's unstoppable surge. What's fueling the rally, and could it crack? Gold isn't just shining, it's on a tear, locking in its longest winning streak since February. What's behind this remarkable run? At the heart of the story are mounting jitters over a potential U.S. economic slowdown, causing investors to scramble for safe haven assets. On top of that, many traders are now betting that central banks might slash interest rates soon, adding extra fuel to gold's momentum. Picture this. In early Asian trading, gold hovered at about $3,383 per ounce, a level reached after a sizzling 3% climb over the last 4 trading sessions. But here's where it gets controversial. Is gold's rise really a sign of smart anticipation by savvy investors, or simply a symptom of fear-driven overreaction? Let's break down what's happening in the broader economy. Fresh data out of the U.S. points to sluggishness just beneath the surface. In July, the once resilient services sector barely limped along, suggesting that recent tariffs may be taking a real toll. And this is the part most people miss. Other recent reports revealed a weaker than expected job market, with only 73,000 jobs added, a disappointing number, made worse by downward revisions for previous months. Add in softening consumer spending, and the economic picture gets even murkier. Here's where the debate heats up. Some believe gold's rally is simply a rational response to global uncertainty and cooling economic activity. Others argue that the pace of gold's surge signals a brewing asset bubble, primed to pop once the panic subsides. What do you think? Is gold a smart haven, or is this streak a warning sign most people are ignoring? Sound off in the comments. Does gold's recent performance make you more bullish or skeptical about its future? Would you park your savings in gold right now, or does this rapid climb make you worry it's due for a reversal? Gold prices soar. Fed appointments, interest rate cuts in focus. Gold has surged to its highest point in nearly 2 weeks, capturing the attention of investors as they closely watch the unfolding developments around Federal Reserve leadership appointments. But here's where it gets controversial. The gold rally is deeply intertwined with expectations of upcoming U.S. interest rate cuts and political moves that could reshape the Fed's future. On Tuesday, spot gold climbed by 0.2% to reach $3,380.20 per ounce by early afternoon U.S. time, after touching its highest level since July 24th. Simultaneously, U.S. gold futures rose modestly, closing up 0.2% at $3,434.70. This upward momentum comes as the U.S. dollar slightly weakened, making gold more affordable for buyers dealing in other currencies, a classic dynamic that often propels gold prices higher. What's driving investor sentiment? Markets are now pricing in the likelihood of 2 interest rate cuts by the end of this year, beginning as soon as September. This shift follows unexpectedly disappointing U.S. employment figures for June, which revealed slower job growth than anticipated. These weak data points led to a dramatic political response. President Donald Trump dismissed the commissioner of the U.S. Bureau of Labor Statistics, BLS, who oversees the jobs report, a move that has added fuel to market uncertainties. Daniel Gali, a commodity strategist at TD Securities, commented, "The market is still digesting a whirlwind of data last week, alongside the Trump administration's surprising decision to replace the BLS head. These factors strengthen gold's appeal and support our view that the U.S. dollar is starting to lose some of its traditional role as a reliable store of value." It's important to understand why gold thrives in this kind of environment. Unlike interest-bearing assets, gold does not generate yield, but it gains appeal when interest rates fall and currency values fluctuate, because it is seen as a stable store of wealth during times of financial uncertainty. Meanwhile, President Trump mentioned he will soon reveal selections for a temporary replacement for Federal Reserve Governor Adriana Kugler, who recently resigned, as well as his nominee for the next Fed chair. These announcements are eagerly awaited by market participants, as leadership choices at the Fed, which controls U.S. monetary policy, can have a significant impact on interest rate outlooks and, consequently, precious metal prices. Silver also experienced a notable jump, increasing 1.2% to $37.85 per ounce, hitting its highest point since July 30th. Bob Habercorn, a senior market strategist with RJO Futures, expressed greater optimism for silver than gold, predicting that silver could break above $40 an ounce and potentially aim for $42 if momentum holds. This enthusiasm highlights how silver, often called the poor man's gold, can sometimes outperform gold during market shifts. On the other hand, platinum and palladium did not share the same fortune on this day. Platinum prices declined by 1% to $1,316.35 per ounce, while palladium dropped significantly by 2.1% to $1,181.21. Adding another layer to the palladium story, South African miner Sibanye Stillwater has called on the U.S. government to impose tariffs on Russian palladium imports. This proposal comes as part of efforts to safeguard the long-term supply and viability of palladium sourcing domestically in the U.S., a move that could introduce volatility to prices and spark debate about trade policy and supply chain security. All eyes remain fixated not only on the price charts but on political developments. How will the Fed appointments and potential trade measures shape the economic landscape? And more importantly, what does this all mean for the future of gold, silver, and other precious metals as investments? Is the market underestimating the impact of the Fed's leadership choices or overreacting to job data and political maneuvering? These are vital questions for investors and analysts alike, and they deserve your input. Do you think that gold will continue to rise amid these uncertainties, or is a pullback inevitable? Share your thoughts and join the conversation. Reported by Sarah Qureshi in Bengaluru. Edited by Vijay Kishore and Sahal Mohammed.